Hello and good morning. So far, I had made a few presentations, short presentations on probability and statistics for my students due to the temporary suspension of classes due to the COVID crisis. But today I decided to do something different and look at some data coming out of finance from the world of finance, especially from the stock market and gold prices. The purpose of this exercise is that, as you might be aware, that over the last 1 month there has been some severe correction in India and worldwide equity markets as well as in commodity prices. Now, how severe is this correction, and what does this really mean for retail investors like us? I just want to present some uh, empirical facts, that means data based observations, not my subjective view, and compare them with some of the past corrections, especially those in 2008-9 due to the global financial correction. And I will just talk about the Indian stock market index, especially the BSE, that is the Bombay Stock Exchange SENSEX sensitive index. So I would read some of the data from you first on SENSEX. By the way, this information you can find easily if you just on your computer screen on a Google, you type SENSEX, and then you will have a chart. As I can see here, I cannot share the screen in this presentation, so I'll just read from some numbers from this which I have recorded. So in January 2020, this Sensex was around 41,945 to be precise. And in 20th March, that is last Friday, it came down to 29,915. So this has been a correction of almost 28 to 29% over 3 months. I must mention here briefly that on 19th March it was even worse. But on Friday there was some recovery rally due to mainly short covering, as has been reported in Economic Times. But nevertheless, even today we are down by 28%. Now, if I go back in time, where we were, where what does this value 29,000 represent, or how severe is this fall? Then we have to go all the way back up to 17th March 2017, that is from 3 years ago, to come back to this value around 29,648. So in terms of the Sensex value, just over a correction lasting for just 3 months, we have been taken back in terms of valuations to 3 year back level. Now, if you look at this graph of the Sensex over time, you can find that only such a severe correction where the price or the Sensex value has gone back by almost 3 years had happened in during 2007-8 period. So in December 2007, the Sensex stood at 19,900, close to 20,000. Then after the global financial crisis emerged, then almost for 1 year it fell, with some relief rallies in between, and around 8th December 2008 it corrected by more than 55% and it came around 8,900. But then this was a fall during the height of global financial crisis, and that took almost a year, and it was at its worst during the October of 2008, and I was in the middle of that crisis. I have clear memories of that time. Anyway, now you see, compare first of all that fall with the recent fall over last 3 months. So in 3 months we have gone down by 30%, and even during the global economic crisis we were down to a 50% kind of correction over a period of 12 months. So we have been taken down in valuation of the Sensex in a span of just 3 months in the recent times, which is almost comparable to a correction or fall in the price of the Sensex over a period of 8 to 9 months in 2007-8. Now you may say that okay, that was a 50% plus correction, and this to this time around, albeit in 3 months, but we have gone down by 30%. So how far we can go? Of course, no one knows where is the bottom, but if you compare the fall, that 50% fall, this is important. If you compare the 50% fall in 2008, then the Sensex was, as I mentioned, around 8,965, 8,900 level. Now you have to go back again 3 years from 2008. So around 2000, November 2005, you will find that the Sensex was at that level, slightly lower, but okay, 8,700 kind of level. So the point is that even after a global economic crisis like 2008 and 1 year stretch correction, the valuation had been taken back to 3 years back, that is 2005 levels. And this time around, after this fall of just 3 months, this severe correction of just 3 months, we are back to the levels of 2017. So in 3 months time, the fall has been so severe that we have gone back to the levels that was in 2017. So here the percentage wise comparison with 2008, yes, you can say now we are down by 30%, but that time it was down by 55%, but here over 3 months, that time over 12 months. But the similarity is that the severity of correction is such that we have been gone back in Sensex valuation by 3 years, and this has happened over just 3 months. So just imagine the severity of correction. Now if I look at the 10-gram gold prices, so from 14th February to 17th March this year, the gold prices have depreciated by 8%, although there has been a slight pullback. And then if I look at some of the short-term bond funds, mutual funds, which invest in short-term fixed security instruments. So for example, HDFC short fund, ICICI Prudential short funds, these you can find in Money Control. There you can easily see that almost all the short-term bond funds have corrected by more than 2 to 1.5%, has fallen by 2 to 1.5% in their value in last 1 month. So the broad point is that equity market has seen a severe correction, a fall that has taken us back in valuation of around 3 years. Gold prices has fallen by 8%, and a bond price, mutual funds which invest in bonds, their valuation prices have also, NAVs have also fallen by 1.5 to 2%. So the point is, why is this happening? Generally what happens is that when equity prices crash, the money goes to other assets like gold prices or bond prices, they appreciate. But this time there seems to be a flight of money from all asset classes. So the one of the answers is that if you look at the India VIX, India VIX or India Volatility Index is an index in National Stock Exchange, NSE, which measures I will read it, which measures the investors' perception of markets volatility over next 30 calendar days. So whatever the VIX number is today, it is a measure of, it will measure what is the investors' perception or fear about markets volatility. Now usually this number is an index, so it says it's a number is supposed to be between 13 to 32, and the higher above 30 it represents high volatility, expected volatility. But now it is on 20th March, it is 65. So that means what is normally considered to be high volatility, it is double of that. few days back it was in 80s, now slightly down by 7-8% from there, but even by today 20th March value, it is twice of the almost upper limit of what normally is considered to be high. 30 or 30 plus range for VIX is considered a measure which reflects high degree of expected volatility. It is twice of that. So everybody is happy. So this is also called a fear index. So everybody seems to be in a panic mode, and so this partly explains or reflects this extreme behavior that we are seeing in the financial markets. So there seems to be a flight of money from all asset classes to liquidity. So it is almost like people are holding on to their cash, selling whatever they have at whatever available value, and selling and holding on to their cash. So this is a pure panic driven market. Here, valuations or the fundamentals are not mattering so much. As the VIX represents, there is very high level of uncertainty, and people are just panic driven. So this is a observation that I wanted to share, that so as the VIX value is suggesting that in the next around 1 month, there seems to be a perception of fear among the investors. But I think if we look at the valuations of the SENSEX, as I have just mentioned, they have gone down substantially. So I expect and I hope that after some time, that when once we have clearer picture about the current pandemic, more data comes in, this situation will somewhat normalize. Because now if you look at some of the share prices today, I will not get into those details. If you look at the individual, some of the share prices that make up the SENSEX, there's does not seem to be statistically much scope for further 20-30% corrections, because ultimately after a time it becomes a bit, there is no point shorting those equities. So this is my observation that I wanted to share with you. And that is partly because I have seen some articles. I would not mention their names individually, in some respectable newspapers, that which are suggesting that this is probably the time to jump in and put money. I think a caution is better advised, and one should be systematic. I am not suggesting that we should panic, because panicking will not help. Whatever fall had to happen has happened. So I think it is best to be systematic now. But this is the some data that I observed, and I thought it would may be of some interest. Thank you.